Alli McCartney is Managing Director at UBS Private Wealth Management. She joins us now. Alli, take us inside some of the conversations you're having right now. We're hearing a lot of folks say, hey, look, bond yields all of a sudden are paying you a little bit to stay safe. On the other hand, are we not in the business of looking to buy equities when they're down, 23% off their highs? So how's the risk reward set up?
Look, so yesterday was a tough day, and it was a tough day because the three questions that investors had of the Fed were answered, and they were answered in sort of a negative light, right? How, when, what? How high are we going? When are we going to get there? And what is going to make you pivot? And the reaction was therefore sort of a puking out of risk in an environment where there was very little risk on to begin with. You just had the B of A asset manager survey come in at a historical high for both bearishness and cash on the sidelines. And that's what you're seeing. And you're seeing that, to the point you just made, on the equity and the fixed income side. We are in a very strange environment. Going back to history, which I know Sam was talking about, and I think a lot of us use as sort of a relative benchmark setter for our investment decisions, 2% of the time in 12-month rolling periods, stocks and bonds have been down at the same time. The bad news is we're in that 2% of the time. The good news is that relative normalcy, that 98% of the time, is in front of us. So there seems not to be, again, on either equity or bond sides, a lot of urgency right now. But just like some of the stocks that we were just talking about, FedEx, Block, there is so much negativity priced in that any surprise to the upside, whether we see that in economic data, CPI, the energy crisis, that could be a great time to get into the market. But you have to have your time horizon. You have to be able to differentiate the short-term murkiness from the long-term opportunity.
Yeah, on some level, it seems like a fairly linear process we've been going through this year, right? We had a highly valued market, yields went up, valuations came down. Now we're all maybe waiting to see how much earnings have to come down in this economic slowdown or stall or downturn, whatever we're in right now. On the other hand, the macro stresses seem to be building up, too. When you're looking at currency markets, you see the extremes in the way the dollar trades, the velocity of the move in global yields. So it would almost seem like if all we're dealing with is corporate fundamentals and the discount rate, it's OK. If all of a sudden we have to be on alert for some kind of macro accident, that seems to be a different story, Alli.
Yeah, look, and you've pointed a lot of them out, but there are even more. So we have macro challenges, we have micro challenges, we have hyperbolic moves in markets, whether it's the dollar, whether it's interest rates that we've never seen before, even isolated. So all of this together means that the level and the appetite of willingness to take risk is really, really low. But to the point you made earlier, you actually have fixed income yields. You can buy a 6-month treasury and you can pocket that yield. You can start to think about really building a portfolio on a fixed income. So not only do we have an amazing amount of overwhelming uncertainty out there, but we also are starting to have opportunities we haven't seen in a while. And and this gets talked about a lot, but I really don't think people understand it or give it as much power as it should. There are 15 years behind us of free money at virtually zero interest rates, and investors that have only experienced that kind of economy, which really has very few repercussions on either the micro or the macro side, or professionals who have lived through it.
Yeah, for sure. It's definitely been a bit of a tidal shift in expectations and conditions. I mean, look, the 90s tech bubble happened with yields at 5% and 6%, and people managed to take risks. So people just have a different equation in their heads, I think, right now for what all that means. Alli, thank you so much. Sam, one other point I think maybe it's worth making, which is by the time the recession is here and now and obvious and declared, stocks have often done the work to the downside. How has that tended to operate?
Well, you're absolutely right that the market tends to top out about 7 months before the recession hits. and then it bottoms about 5 months before the recession ends. And usually the NBER, National Bureau of Economic Research, doesn't really tell us we're in recession until 8 months into the recession. So as a result, usually when the NBER tells us we're in recession, that is typically a good buying signal, because from a timing matchup perspective, most of the negative news has already been factored in.
Yeah, we talk a lot about lagging indicators, whether it's employment or something else, and the NBER might be one of them, but they haven't talked yet. So, Sam, thanks a lot. Appreciate the time today.